China and the US have been busy digging a grave for the other this week, but they'll probably end up walking into the one that they dug themselves anyways. Welcome to Worldwide Economy. We'll start off with an indices recap. So essentially this week, the American S&P 500 moved up 0.7%, the Dow Jones moved up 0.11%, Nasdaq 1.8%, and the WIG 20, it moved down 3.8%. WIG 20 is a collection of the 20 biggest companies in Poland, and since I'm here right now and that's where I'm from, I'm going to keep note of it in the show. So especially on Monday this week and the end of the preceding week, since as you know, the economy is very integrated, globalization, all that kind of stuff. All these kind of indices, they tend to move in some sense of harmony. And following what has mainly been a product of the US-China trade dispute, stocks worldwide have taken a hard hit on Monday this week, especially where many stocks had a shock fall. Some of my investments, for example, fell as much as 7%. The aforementioned indices took hits of up to, I think it was 4%. So obviously on the whole kind of macro scale, there have been some great effects of the uncertainty from the US-China trade dispute and what has been recently coming out of it. So just before I get into the meat and potatoes of the show, I just like to give a quick announcement. So over the past week, I've been working on getting this podcast to many platforms. So right now I'm available on YouTube, where you can see the video version of this. You can see my beautiful face, as well as the graphics and infographics, all that kind of stuff that I show on my screen here from the articles. I'm also available on Stitcher, Soundcloud, Spotify, and iTunes. Those are obviously just audio exclusive versions. Furthermore, as a kind of appendix or addition to this week's podcast, I will be releasing, I can call this episode 2.5, later this week, probably midweek next week, and you'll see in a sec. So I've shared the kind of schematic of the show. So obviously I've added the indices. I'm also going to add a section where I go over this week's news and headliners. So just very 1-minute recaps on what's been happening, maybe some stories of interest which you guys might want to check out. And then obviously the kind of main stories and what's been happening. Right, so in this week's news and headliners, we have the following. Warren Buffett's Berkshire Hathaway cash pile has reached an astounding $122 billion US. So essentially at the latest annual shareholder meeting, Warren Buffett was actually asked about the cash pile. This happened a few months ago, and whether it would have been more wise, or at least certainly more profitable, to invest this capital into, let's say, an ENF or an index fund or something that just tracks the general stock market. And so he replied, yes, it's obviously much easier said than done when you're managing the sum of money that Berkshire does. And in this case, you really need to manage your risk appropriately. You need to certainly limit your risk exposure, and with that comes keeping some money in cash potentially, like he has now. He also added, along with Charlie Munger, that the two are waiting for a takeover, or just the merger and acquisition. Waiting for a great deal in the form of a different company to be picked up off the market. But at this moment, equities are too overvalued. So obviously, as you can imagine, $122 billion, that puts them as essentially a crazy big private equity firm. In other headlines, I read an interesting article on sin stocks and ETFs associated with sin stocks. So essentially, this is the kind of standalone video and article that I'll be making about. And like I said, I'll call it episode 2.5. But anyways, you can check that out in just a few days. Sin stocks are firms whose operations are mainly involved in alcohol, tobacco, gambling, etc. Many firms and investors have divested from companies operating in those areas recently over the past few years, alongside those who profit off of fossil fuels, so unclean energy or non-renewable energy more specifically. So divestment is quite literally the opposite of investment, and people have explained these moves to be fueled by ethical objectives, or more socially and environmentally focused goals. But there's obviously some room for analysis. Based on my skeptical and critical nature, I provide a short commentary on it and talk more about sin stocks, the kind of mega trends and macro trends of where our economy is going. And maybe people are just riding the wave, but it really comes down to kind of your core values and whether you're more focused about an ethical your investments are focused more about your ethical kind of goals or nature, or potentially just a monetary gain. Not saying that those two can't coexist, but there is certainly a dilemma. Anyways, you can head over to my blog, my podcast, if I upload it there, on the stocks and since stocks and macro trends, since it's a very interesting topic. Anyways, let's get on to the actual story of the week, and that is it's a product again of the US-China trade dispute. I think we'll be talking about this for quite some time. It's been going on for ages, and I don't believe it's going to stop anytime soon. I believe the economy is going to completely collapse before they come to any kind of conclusion on it all. But anyways, right, what's been happening? Well, at the beginning of the week, China devalued their currency to below the 7 Chinese yen per US dollar level. So you may have heard the specific line between, like said about 20 million times, I sure have. But, there's a reason for this. There's level similarities between what we're experiencing now and what happened 11 years ago. Because, 11 years ago, just as a great financial crash was taking place, and obviously people are beginning to worry because of this. And like I said, the kind of last time that China's currency dipped that far below that certain threshold, that 7 renminbi, I think it's called the renminbi, or just the Chinese yen, was 11 years ago. Nevertheless, the way a devaluation works essentially is that China, or any exemplar country, will look to affect the supply and demand of its own country. Usually it's the supply on the foreign exchange market. So in this case, and one which is the most common, like I said, a country is going to sell its own currency onto the market. So in other words, buy another currency and pay for it with its own currency, and therefore it's going to increase the supply of its own currency on the market, lowering the price given an unchanged demand. So what this leads to is a cheaper yen or Chinese yen, and therefore cheaper Chinese goods to foreign entities. So this was essentially done partially to offset Trump's tariffs, which initially made Chinese goods more expensive to buy for American importers. And obviously there's a lot of trade going on there, so it's very important for China to do that from their point of view. But some have been calling this a second Cold War, beginning of the next financial crash and worldwide recession. So etc., etc. Overall, very positive vibes. So I'm going to move on to my screen on my computer here. Now, I've got an article up from Financial Times, and it essentially shows the way China's currency is managed. So let's say we can take the US as an example. They've got a free float exchange rate mostly. So they'll leave the exchange rate of their currency to be all down to the kind of market supply and demand. China, on the other hand, has a more authoritative approach. They will have a managed float. So they'll set a certain target for their currency, and they'll allow their currency to trade within plus minus 2% of that day in, day out. So on the screen, essentially what it shows you is the trading band floor and the trading band ceiling of their currency, and then the actual exchange rate, which is in between, which is the actual rate at which its currency is being sold and bought for in respect to the dollar. So essentially, after the devaluation, the currency dipped below the 7 yen per dollar mark, and essentially there's been some serious market or serious general implications based off this. I'll read an extract from the article. The market implications of breaching 7 are tremendous, said an economist at Commerzbank. We will see a new wave of depreciation among Asian currencies in the foreseeable future, and there could be further risk-off movements in the global markets. It looks like a tsunami is coming. So obviously there is some risk involved in this whole kind of situation and how this may further impact different Asian countries, but we are yet to see exactly what may happen. Continuing on from the article, cracking 7 in currency trader talk is seen as a breach of a psychologically important threshold for the renminbi among ordinary Chinese who have not seen their currency weaken to the current levels since 2008. Again, exactly what I said earlier. It's to do with the kind of similarities between today and what's been happening, or what happened, 11 years ago. So obviously there is some psychological implications and effects on this, and even though, let's say, an economy might not be doing bad, people will expect it to do bad and behave as if it was going to be doing bad. So even though, let's say, if we're not on track for a recession, the fear and the kind of lack of confidence of consumers and businesses might lead us exactly in that direction. Anyways, we can actually go further on to the analysis, also what's been happening is that Donald Trump and I think the whole, just the US has accused China of being a currency manipulator. So I'll read an extract from a second article, and this is an Opinion Lex piece from Financial Times, again, a very nice site. I'm reading from the article. The US has designated China as a currency manipulator for the first time since 1994. This looks political. China met just one of the 3 US Treasury criteria of a currency manipulator. Even so, the US may impose penalties. So I've actually got the criteria up on another document. Let me just pull that up. Right. So the US Treasury actually tightened these rules, or these kind of set of regulations, not regulations actually, just the kind of criteria, sorry, to be more inclusive of various countries. Anyways, currency manipulation criteria as per the US Treasury. So this actually changed or tightened earlier in May. So the first criteria is a bilateral trade surplus with the US that exceeds $40 billion US. The second is a current account surplus that amounts to 2% of GDP or more. And the third is a persistent one-sided intervention in which net purchases of foreign currency total at least 2% of a country's GDP over a 6-month period. So that essentially just looks at the kind of activities on the forex market of the company, of the country, sorry. Right, so as the article mentioned, they only ticked one of the criteria. That is true. China only ticks the first one. They've got a trade surplus which exceeds $40 billion US, I believe. And aside from that, the criteria are left alone. So again, that's exactly what the article argues, that this just looks political. And it seems so that way. I'll carry on reading to aid the analysis. A weaker renminbi should help Chinese businesses cope with US tariffs and a manufacturing slowdown. Exporters should be able to bolster weakening profit margins. Smartphone makers, including Huawei, a US security bugbear, and Xiaomi are among the electronics groups that would benefit. Yeah, so this is essentially the first kind of point of analysis, the fact that if the Chinese currency is made cheaper, or devalued, then it's obviously made cheaper for, let's say, American citizens to buy the currency. So it appears that the Chinese goods to American importers start to look less expensive, i.e. cheaper. China has not actively sought to weaken its currency so far. Over the past 2 decades, the renminbi has priced stronger against its currency basket in more cases than not. A stronger renminbi means more spending power for its companies and citizens overseas. And here is the problem. This looks at a stronger renminbi, whereas in reality what's happening now is that it's become weaker. It's been devalued. So what does that mean? It means that there's less spending power. So even though the Chinese government is aiding those companies which are hurt by the US tariffs, because I believe they've already come into place. I think it was actually the 1st of August, or maybe it's the 1st of September. I don't exactly remember. Anyways, what that means is that yes, it offsets the tariff impact on the Chinese companies, since the tariff makes those Chinese goods or associated, goods more expensive. The devaluation of the Chinese currency and essentially the weakening of it down to over 7 renminbi or Chinese yen per US dollar, it makes it cheaper again. So it essentially offsets that effect, potentially even aids those main kind of exporters, Chinese exporters affected. So overall could be good for them. However, what it means for the rest of the Chinese citizens is potentially some negative effect, especially on importers. So again, if your spending power falls overseas, that means you can buy or import less foreign goods, or potentially you might have to spend more on your imports, so your cost of production increase, and then you pass on the price to the consumer. And as a Chinese company, what that means is that you've got inflation within your sector if you don't switch to a cheaper alternative. And really it's the same, actually, it's very similar to what's been happening or what has happened in the US with the tariffs. So essentially for those companies who keep on buying Chinese goods or essentially switch to domestic producers which are still less competitive than what everything was pre-tariff, because otherwise they would have been on domestic producers anyways, essentially leads to higher prices through higher costs of production in the US through tariffs in some areas, as well as now China in general, because unlike America, which has placed some tariffs on specific Chinese goods, China has devalued their currency, which impacts all trades in and out of the country across the board. So essentially, from the point of view of the Chinese economy, whether this was a good or bad move, it has to be evaluated based on the benefit gained from the exporters, which were first negatively impacted from the tariffs, versus the total gain in exports, essentially, from the weaker currency, as a weaker currency improves exports, as your goods seem cheaper to someone else that's foreign, so they'll buy more of your goods, versus the negative impact on your imports, and essentially, quite literally, the increased cost of your imports versus the increased benefit of your exports. Again, we'll have to see, because in the long term, this is certainly not sustainable. As the article says here, China will be reluctant to shift its stance permanently. Longer term, a weaker renminbi would hurt confidence and trigger capital outflows. That's exactly what's actually been happening in the UK as well. So essentially, with Brexit, the currency, especially around 2016, 2017, took a hit. Recently, it's been getting weaker again, except it's not because of devaluation, but simply a lack of confidence and capital outflow. So what you've seen in the UK over the past few years is a lot of jobs flowing out, a lot of businesses relocating their headquarters to like Frankfurt, or just areas in Poland as well, or just really mainland Europe, which wherein countries are obviously going to stay in the EU. So there's capital outflows. There's obviously a lot more lack, I guess you could say, of confidence in the UK, and very similar effects. Again, I'll keep on reading from the article. China cannot outgun the US on tariffs, since exports to the US are more than double US imports to China. China has so far retaliated to US trade hostility with symmetrical force. Its use of currency is true to that playbook. So again, as the article mentions, the US has more leverage in using tariffs to combat or to use as a weapon in the trade war than China. China has moved on to using its currency as a weapon as well. And we'll see what it holds, because like I said, whereas tariffs are a one-way channel between American importers and Chinese exporters of whatever the goods were, I think it was something to do with agriculture. Those are steel and many other things. To be honest, Trump has placed a lot of tariffs. But then again, contrast that to China and their whole currency losing value, or losing, strength essentially. And I guess we'll see what will happen. Essentially, a cool quote, before you embark on a journey of revenge, dig two graves. That's kind of where we started off this show, and that's where we are now. They're both hurting their economies quite literally, because whether it's a form of protectionism that is direct, such as quotas, trade tariffs, or more something like changing your currency, devaluing, revaluing a currency, so that is instead of increasing your supply to devalue, you can decrease your supply to revalue. So obviously it becomes stronger. There's forms like you can give tax break to companies, specific companies, targeted companies, and subsidies to make them more competitive on a worldwide stage, not worldwide. But yeah, actually, this is something I want to point out as well. Okay. Moreover, a weak domestic currency is bad for many other Chinese businesses. Again, I've mentioned this a few times. Corporates with large amounts of US dollar denominated borrowings, such as Chinese airlines, would be exposed to higher debt service costs. China Southern Airlines, Air China, and China Eastern have fallen more than 6% in the past 2 trading days. Obviously, this article is a few days old, underperforming broader markets that are already weak. Yeah, this is another point. So essentially, as we've talked about, essentially a weaker domestic currency, in this case the Chinese yen, what that means is that, one, obviously your local consumers have got less purchasing power, so either they import less or they import the same at a higher price now, or essentially essentially they have to pay more of the Chinese yen to get themselves a dollar. So if any companies like just the aforementioned airline companies who have US dollar dominated borrowing, so that is debt in dollars to pay off, the same $100 debt that they had a year ago and they have now, they're going to have to spend more Chinese yen to essentially pay it off. So the costs increase. Obviously, airlines, they tend to have a lot of debt. They tend to have a lot of debt to equity or debt in respect to the whole kind of business operation, since it's a very capital heavy industry. So that is obviously part of the business, and that's what they're essentially going to suffer. I'll quickly look at the comments of this article. Obviously, as I always do, or have done the one time I did this podcast, there's actually only 4 comments here, so it's not a wildly popular article. When did this come out? It came out 4 days ago. Anyways, the top comment here, which is the one I'll pay attention to, the rest seem to not add value. Shouldn't Trump get the currency manipulator label? He caused the 7 break. Again, people like pointing fingers in this kind of scenario, but if you really look at the whole trade war, it's been going on for a very long time actually, and both parties have used protectionist policies. So for example, with Trump, he's used tariffs. He's used all sorts of economic threats, to be honest. In China, they've devalued their currency. They're using a very short-term kind of method to potentially get a long-term result, obviously, as they're hoping. But, I mean, it's a bit of Trump hate. It's hard to give just one person a label. I mean, it's not like he devalued their currency, so it's a bit of a nonsensical comment. But at the same time, people need to realize that, firstly, the trade war isn't something that's new. Second of all, there's more to a trade war than just the tariffs and, the devaluing of currencies, the direct kind of methods employed in all of this. So, that's what people need to realize. And I guess for now, for the week ahead or the month ahead or whatever, depending on how long it's going to go on for, like I said, I predict it's going to go on for a long time. We'll see exactly what is going to happen. But for now, this is where we stand. We stand with a lot of tariffs on one side, China devaluing their currency to combat exactly that. And actually, another comment, maybe it was on this article, another comment that I read somewhere else, I guess, is the fact that now Trump, what this does is that it's actually it's increased, the imports from China net. So obviously, as we know, Trump is against importing a lot of goods from China, but the fact that now the Chinese yen is a lot cheaper, people might cut down, like I said, from the tariffs on importing the goods that have got tariffs placed on, but they might actually import more of other goods, which now are cheaper and obviously more attractive to American consumers. But again, we'll have to see. This has just come out, and to really look at the impact of this kind of stuff, it takes some time, really. You want to get at least 1, 2, 3 years outlook on what's been happening. Obviously, we'll be able to see the impacts quite immediately because the prices quite literally change overnight. But to really give a fair evaluation and learn more about the topic, we really need to take a more holistic approach, and that simply takes time. But anyways, guys, for now, that is it for this episode, second episode, where we talked about currency manipulation from China. We also talked about some cool sin stocks and some small headliners. But essentially, that is it for today. I hope you guys have enjoyed. Again, please have a look at my YouTube, where you can view the video version of this, unless you're watching it right now, alongside some other content. Like I said, episode 2.5, we're going to be covering sin stocks in a bit more detail than I have today. So that should be quite fun and interesting, I guess. So anyways, I hope you guys have found this entertaining and educational, especially since this is all very contemporary. Any comments, please do leave them by. I really want to improve this, and I have a lot of fun making this. So obviously, I want to kind of share my joy through methods of kind of entertaining and mainly just teaching people what's going on and kind of reading some opinions and general analysis on this from an economic kind of theory standpoint, as well as the more in-depth analysis that we see in Financial Times and more stats, more of a holistic outlook. But anyways, guys, thank you guys for watching, and I'll see you next week.